Okay, if we can get started. We're starting late, and we're going to try and we're going to keep to the original closing time, since several of the participants on the panel have, as I'm sure all of you do, commitments that they have to get to. So when you think back and how this forum has an uncanny way of picking topics and sessions, who would have figured where we are? And so rather than get into a lot of discussion about it, I think you see it on the newspapers and television constantly in terms of the crisis that we're in. We've got an excellent panel. Bob Kimmitt, who's the Deputy Secretary of the Treasury, who works obviously very closely with Hank Paulson, who's driving the recovery plan in the U.S. Jean-Claude Trichet, who was one of the few, if you remember back a year ago at this forum, who reminded everybody here to beware of complacency, and also as the head of the ECB, took a real lead in this area this past August. On the private sector side, Wes Edens, the chairman and CEO of Fortress Investment, who obviously has intimate first-hand knowledge of complex instruments and transactions, and Jamie Dimon, who's had a very broad and deep career in financial services and banking, who currently leads JPMorgan, and obviously when you look at it with a very calm and steady hand. So good panel. What I thought I would do is I've got 4 broad question areas that I would take them through. I want to say there are no opening statements or prepared remarks. The panel is on the record, and so I would like to have it be a discussion between the panel members. The areas of covering are what went wrong. When we look at this crisis and you look back over the last many years, how is this crisis different from some of the previous episodes that we've seen? What are the issues that we have to get resolved going forward? And how should policymakers and obviously the financial services industry work together as we deal with solutions? So I'm going to start with Wes. He's in the business of alternative asset management. Wes, how much do you rely on these modern financial instruments and derivatives to pursue your investment goal? And Warren Buffett said when he compared some of these derivative instruments, these were the weapons of financial mass destruction. So how do you react to that?
I think when Warren said that, I remember reading something in the press where someone had responded that, to the fact that guns don't kill people, people kill people. And broadly, that's how I think about financial derivatives. We do use derivatives extensively in our businesses. In the private equity businesses where we actively buy companies, we're using them really exclusively to hedge various risks that we may have, interest rates, currency risks in particular. On the hedge fund businesses, in particular the macro side, we frequently express investment theses through financial derivatives. It's a very efficient way in certain cases to make efficient and cost-effective investments. I think in this in this current financial crisis that we're in right now, one of the things that I think is actually very interesting is that the development of a subprime financial derivative, an index, the ABX index, is one that was very widely used for hedging. One of the aspects of credit that is so interesting is that you can't really effectively get short the instrument of credit itself. So by definition, if you want to hedge it, you have to go to another instrument. And I think that when we look back, hopefully soon, on the end of this crisis as things normalize, we'll conclude that in certain respects that derivative product itself contributed to the volatility of this overall state of affairs, and that you had an instrument that basically was used very extensively for speculative purposes in addition to hedging, and I think that the volatility implied by that actually had at least some part of the reaction we've had.
Jamie, do you want to add anything to that, or focus on how this crisis differs from the other crises in, let's say, the sovereign debt crisis of the 80s, or the Asian crisis, or LCTM? And is it really correct to say that the banking system would be in dire straits if it still had the same structure that we did have 20 years ago if securitization had not occurred?
Right. So, I remember, this is kind of good news for the reporters here, but I was really happy in about September because my daughter called me up and said, "Dad, 20 years old, going to college. Dad, what's a financial crisis?" And I was happy that she was reading the papers to start. And I didn't say it as a joke, but I said, well, the financial crisis is that thing that happens every 5 or 6 years, because you mentioned them. We had the '01 internet bubble crash, with the '97 LTCM Russia crash, which started, by the way, with the failure of asset-backed taxi cab loans in Thailand, which started the crisis, went on for 9 months. We had the '90 real estate S&L crisis here. We had an '87 crash. The market went down 25% in one day. And you can measure these things up. The market crash in '01, $4 trillion were lost. The subprime thing, $300 billion. And so no, this is the world we live in. I am always surprised that people are so surprised that we have cycles and things like that. So the real question is what's new and what's different. So I'm going to speak quickly. What's new is there was a housing bubble. The first person, as Warren Buffett says, who was swimming naked out there, you find out who's swimming naked when the tide goes down. The first person swimming naked was subprime. That ended up in CDOs, CIVs, and these insurance companies, and filtered through the markets A, B, C, P. That's the new part, and it's got all these new ramifications. It hasn't quite happened this way. Mistakes were made. What's not new? There's a liquidity crisis. All risky assets reprice. A lot of the problem, even in subprime, was people financing things short that were illiquid assets on balance sheets. So there's a panic. The markets go down, the R word, recession, takes place. And I mentioned a bunch of these crises. Remember, they didn't all cause recessions. So I know there's a lot of conversation about what this will do, and I'll leave that to the economists. So there are differences, there are obviously similarities. A couple of lessons learned. A lot of assets become illiquid very quickly. And I think the financial community has more of those in the balance sheet than they thought. Capital is paramount. And I always tell people having real capital is not a philosophical conservative thing. It's really a strategic imperative to have money when people don't, so you don't have to be raising money. Risky assets reprice, and they reprice drastically. Accounting will often hide that, and that's usually internal. Are your people transparent? Do you have the facts? Do you have open conversations? Do you have the right people doing it? So there are legitimate things that need to be fixed in mortgages, subprime. I think securitization, honestly, some things, Warren Buffett, I'll quote him again, it's a good thing gone to excess. It's not going to go away, but there need to be some changes made that make sense. And I would add other things, a whole long list, like when you have big illiquid assets and a lot of profits being earned in year one, and you're paying people in year one, but the real profitability is not known for year 2, 3, or 4, you're creating disincentives that also create another series of issues. So these will all be taken up, resolved, reformed, and hopefully we'll end up with a better, stronger system.
I don't know if any of the other panelists want to comment on their view of this crisis differing from the other crises, or?
I think one thing that I think is very strikingly different about this time around is that in 1998, when you had a financial crisis and the Russian debt, defaulted, and then that precipitated a whole series of follow-on events. And as Jamie said, it was really subprime that was the initial thing that went down, and then of course a lot of other things followed. What's very different this time around is that much of the money that's been lost was lost by people that held AAA securities. If you held Russian debt in 1998 and it went down, it wasn't like you thought it was a AAA security in the first place. And so what's happened with these very vast and substantial losses in some of the financial institutions that own securities that they thought were, and in fact were, rated AAA, you have price dimensions of something that was at par that went to 20 cents or 15 cents, and so tens of billions of dollars lost. What that causes, and I think with the primary issue we're all grappling with right now, is a tremendous lack of confidence. Because people's belief system in what should be infallible starts with AAA securities. And so once you actually shake that, I think then you have what we have today, which is much less a lack of capital and liquidity in the markets, and much more so a lack of confidence, I think, that exists on investors' parts.
Okay, Bob. So Bob's had a pretty balanced career, both in government and outside of government, and was ambassador to Germany. So I guess the presumption is you know Europe pretty well. So how do you see the differences in how the crisis affected Europe and how the U.S., and what do you think the reasons are?
I think it'd be important to note that the turmoil is still running its course, and it's probably too early to identify all the lessons to be learned. But at this point, I think two things are clear. Number one, the turmoil is taking place against a backdrop of a strong global economy. And that secondly, it is taking place in an era of unprecedented capital market integration and complexity. Picking up on some of the comments of the earlier speakers. And as a consequence of securitization, loans originated in the U.S. were spread out all over the world, including in Europe, which holds the predominant number of these securities abroad. I would note, picking up on Wes's point, that one other thing to note, because there was a great debate last year about regulation of hedge funds and private equity, some discussion this year about regulation of sovereign wealth funds. These instruments were being held in our most heavily regulated institutions on both sides of the Atlantic. Certainly there are effects being felt in Europe. I would note not uniformly across the countries. I would leave to Jean-Claude perhaps to talk to that European dimension, because most of the subprime exposure is in the United States and the effects have been felt most strongly there. I would just note, though, that the U.S. long-term economic fundamentals are sound, and we expect the economy to continue to grow. Nonetheless, because of a number of factors, including subprime, the housing market, commodity prices, growth is slowing, and the risks are to the downside. And that's why I'm here today rather than Hank Paulson, because, as you said, Jim, he is leading the effort to come to an agreement with the bipartisan leadership in the Congress on a stimulus package that will address that near-term downside risk to growth that we think will continue.
Great. Thanks, Bob. Jean-Claude, 20 years, and I referred back, what if we had the same regulations in banking and the like that we did 20 years ago? What's the impact? But we've seen deregulation. We've seen non-traditional new market participants come in. How much of this should be blamed on the changes of deregulation? And what's the challenge for central banks when lending operations are performed now by unregulated entities?
Well, let me first say that a year ago we were exactly there, and as you have said yourself, Jim, a number of us, and I was echoing that, we are thinking that we were living in a financial world at the level of the global finance where there was an underpricing of risks that could be identified. I think it was certainly the sentiment of the central bankers, and I was expressing the sentiment of the central bankers, but it was also the sentiment of a large groupings of private sector participants. And this was illustrated by a very low level of spreads, a very low level of risk premia, a very low level of volatility in general, across the board, in a large array of market segments. And the message that we had at the time was it is not sustainable in the medium and long run. A correction is necessary and unavoidable, and let's prepare ourselves, and I think it was a message for all market participants as well as for authorities, to a correction which would be as smooth and orderly as possible. So that was the diagnosis. We are now experiencing, as Bob said, an ongoing market correction, which is very significant, which is multidimensional, and which, of course, as always, with a very significant market correction, has episodes of turbulences and episodes of high level of volatility and overshooting. That's clear. That's what we are observing. In those circumstances, I have to say that it's up to all participants to be up to their responsibilities, and market participants, institutions, And as part of the grouping of the authorities, I expect a lot from the private sector. I very much encourage the private sector to work a lot on best practices. And I know that a lot of work is being done, including in the IIF, with a lot of working group on the best practices, and we would certainly encourage them very much. I mean, on risk management, on conduits and liquidity risk management, on ratings, valuations, and so forth. As regards the public sector, we are working a lot, I have to say, in the various Gs, including the Financial Stability Forum, to draw the lessons. As Bob said, it's too early to draw definitive lessons, but we know that we will have to improve global finance in all absolutely respects and all angles. And I'm sure that there are provisional lessons to be drawn. Transparency is absolutely of the essence. We had already that observation in the time of the Asian crisis. It's absence of transparency which had triggered the contagion. Again, we are in an episode of turbulences where absence of transparency on the sophisticated instruments, on the institutions themselves, on the real situation of the market is part of our problem. And so that is extremely important. That being said, I have also to say that we have certainly to look at all the elements in the present system at a global level which are pro-cyclical and try to get out of the pro-cyclicality as much as possible.
Bob or Jamie or Wes, you want to comment on any of that at this point? Or?
No, I agree wholeheartedly. I said there's one other pressure, which is more of a management kind of thing, but a lot of managements are constantly being asked, how are you going to grow, how are you going to grow, how are you going to grow, how are you going to grow? And in a risk business, any risk business, so it could be in your insurance business or any risk business, well, one of the easy ways to grow is to leverage up and take more risk. And that pressure, I think it takes a lot of fortitude on the part of a lot of CEOs to say, I'm not growing. I'm not adding the risk. Now's not the time. And it's just kind of one other thing that's in there. I don't know how you solve that problem, but I've seen it happen many times with many firms.
Yeah, I think, I've been hearing others talk, and you mentioned the insurance industry and managing risk. I think everyone's looking at the risk processes and systems if something's broke, but I think you have to say it's how the managements use that and the appetite for risk under the pressure to grow that we've seen. So, Jean-Claude, let me ask you, the central bankers and the concern about price stability, have they neglected financial stability, and do they have the tools to pursue the latter? And I say this, and I'd ask the others to come in after you've had your comments on here. You mentioned global finance, but most of the central bankers are dealing in individual sovereign solutions as opposed to us finding a global solution. And from the outside, the question is, how do the central bankers all come together to solve the global problem?
First of all, I have to say that we have a long-standing tradition of looking at financial stability and trying to devise concepts and principles that would be good for all constituencies. We invented, if I may, in our own central bank constituency, the Basel Committee in order to have principles for prudentials in the banking sector. We were the first to do that, and we did that because we had to cope with already at the end of the 70s and beginning of the 80s, we had to cope with a number of global issues. So we have a long-standing tradition. That being said, we are all placed, as far as our economies are concerned, in different economies, different circumstances, different level of shocks that we have to cope with. And I would say that we all, it seems to me, have in mind that at any time, and particularly in times of turbulences, and potential financial instability, what is extremely important is to offer as solid ground as possible, as steady ground as possible, anchor points, if I may. And two very important anchor points from our standpoint are, first, price stability, which is a precondition for sustainable growth and for financial stability, and particularly to solidly anchor the inflation expectations. If you have inflation expectations on a medium long-term basis that would become volatile and disanchored, you do nothing but augmenting, of course, the volatility of the markets. That's as simple as that. That's one anchor. And the second one is to care for the money market when the money market is under tensions, which are the reflection, if I may, of the tensions that are in the overall financial market. And on the first point, it calls for appropriate monetary policy stance, and I take it that we all are doing our job in this respect. And then once you have the appropriate level of short-term interest rates that you have decided for the sake of the anchoring of inflation expectations, then you have to care for the as smooth as functioning of the market. And that's the reason why we all cooperated, as you could see, on both sides of the Atlantic and of the Channel, and with colleagues. And I have to say that speaking of my own institution, we took decisions that were very, very bold, obviously. The 9th of August, we poured liquidity because, again, we had the potential destabilization of the money market, which we could not accept. And we did also, as you could see, a number of liquidity operations, including at the end of the year. Again, I have to say, these were bold. We are equally attached to solidly anchor the inflationary expectations on the one hand, and not let a destabilization of the money market. It worked, but it is no time for complacency. I would certainly reiterate what I said a year ago.
Bob, you have any comments on that? Or?
Well, I would really just pick up what Jean-Claude said. Nations are going to have different circumstances, different policy responses. I think the important key is to recognize the need to be coordinated in our responses. And I'd have to say in both formal and informal channels, both between Europe and the United States and more broadly through the G7, through the G20, an increasingly influential financial institution, I think the cooperation has been close, and I'd say particularly between Europe and the United States. I would just say that if you look at it in the U.S., obviously we're focusing in the near term on reducing the number of foreclosures and minimizing the impact of the subprime turmoil on the real economy. Again, that's why Hank is leading the effort on the stimulus plan. At the same time, we have to look to the mid to long term, and through the President's Working Group on Financial Institutions, chaired by Treasury, but that involves the Fed, SEC, and our bank regulatory agencies, we're looking at key issues like disclosure, origination, predatory lending, and liability. But as I said earlier, we're living in an ever more integrated world financial system, and therefore we've taken some of these same issues into the international marketplace, that is the international government marketplace, and working closely with our G7 counterparts, particularly in Europe, and the Financial Stability Forum, again, like the G20, an institution established after the Asian crisis in the late 90s. We've asked the Financial Stability Forum under Mario Draghi's leadership to look at 4 key factors: financial institutions' liquidity, market credit risk practices, and especially including treatment of complex credit projects and conduits. Second, accounting and valuation procedures for financial derivative instruments, particularly for complex, narrowly traded instruments that become difficult to price in times of stress. And the third is basic supervisory oversight principles for regulated financial entities, especially given exposures to off-balance sheet contingent claims. Again, let's look at how much of this took place inside regulated institutions. And then lastly, looking both in the U.S. but also through the Financial Stability Forum, is the role of credit rating agencies in evaluating structured finance products. Picking up on what Jean-Claude said, I think that the cooperation between and among the key economies represented in the G7, in the G10 in the case of the central bankers, the G20, and then through the Financial Stability Forum, I think has been exemplary, and thank goodness we had those institutions established to produce the opportunity that they do for the kind of dialogue and common action that's so important.
So let me go to Wes and Jamie, and and focusing on the issues going forward. And obviously, you start again talking about regulation and looking forward. So when you look at securitization, Wes, and how this allowed the decentralization and the spreading of risks over many market participants, and you look at the result of some of that, does this call, from your standpoint, for a new approach to regulation?
Well, I think the markets are pretty efficient at providing regulation, and that the securitization itself is a good thing. It provides a lower cost of finance for assets, and even in the circumstances we're in right now, you can get things securitized in a relatively efficient form if it's an asset. So if you need to go finance a house or a bunch of airplanes or a bunch of cars, you can still access the market even in pretty difficult times. What happened, and Jamie mentioned this a little bit earlier, was just the excesses that were then kind of piled on top of that. So the financing of financings, the CDOs of CDOs, these instruments were very complex. Obviously, both the rating agencies and the market participants badly mispriced what the true volatility and the creditworthiness of those instruments were. One of the things that happened between 1998 and the last time there was a big financial crisis to today is that the CDO market, this financing market of financings, has grown dramatically. I think, I don't know the precise numbers, but I think in 1998, only 10 or 20% of the securitizations that were created were then in turn bought by CDOs. By the time the world ground to a halt here last summer, that number had grown from 10 or 20% to 70 or 80%. So, much of the product that was created through securitizations was then being fed back into another form of securitization. And I think the primary culprit in the growth of that, in large part, were actually the liquidity provisos of the banks. These 364-day liquidity letters of credit that were written, that were never intended to be true credit events. If you look at the pricing of these, a bank, I could pick one but I won't, a bank that might have written one for a 10 basis point fee, a very nominal fee to basically provide liquidity for this, well, they found themselves at the end of this crisis actually having to take onto balance sheet and take risk on tens and tens of billions of dollars in assets. Clearly not what they intended at the time. And so I don't think it's a regulation issue so much. I think from perhaps a capital adequacy level, because I think you don't hold capital against these 364-day instruments, that might be the kind of thing that I would encourage the regulators to take a hard look at. But the markets themselves, I think, will regulate the kinds of products that can be created and sold, because if they're not good products, people simply won't buy them, and I think it'll take care of itself to a large extent.
Amy?
I pretty much agree with Wes, so I just would repeat most of it. I think there's good regulation and bad regulation, and I think you have to be very careful when you form policy. Very often it causes the opposite of what people want. And so, I think the policymakers are actually pretty smart, and when we sit down and finish going through this, have a thoughtful meeting with regulators, people who've been through it, and make the world better. That's reform. That's a never-ending state of affairs.
But let's, because a lot of people are talking about this, and then I'll be interested in what Bob and Jean-Claude have to say. The concern, I think the fear, is after Enron, WorldCom, we had a reactionary move to regulation in the Sarbanes-Oxley bill. I mean, there was a lot of discussion here about that, the cost that put on. So are you concerned about that here? I think it's hard to believe that in this environment that we're not going to hear a call, given the scope and size of this, for increased regulation of some sort.
I can say a word if you wish. First of all, we have to accept that regulation have to be permanently upgraded. And the banking regulation is a good example, because you know that we have worked out Basel II after Basel I in banking regulation. And had Basel II been implemented more actively and more rapidly and more quickly and more expeditiously on both sides of the Atlantic, part of the difficulty that we have observed, not all of course, but part of the difficulty would have been probably avoided, namely in Basel II, you have to care for the backup lines that you have in the conduits and the SIVs, when in Basel I it was not taken into consideration. So that is a first observation. The regulation must be permanently upgraded up to the new concepts that are emerging out of the creativity and inventivity of the financial market, which I praise. I think we have to rely permanently on the creativity and inventivity of the financial markets, but we have again to be up to these new permanent challenges. On top of that, I would say that we have also to ask permanently the private sector to discipline itself and to work out the kind of benchmark principles of code of conduct, whatever you call it, set of principles that are necessary, in my opinion, precisely to try to emulate this creativity and inventivity. We were very, very keen in Banque de France, for instance, when I was governor of Banque de France, and it has been followed up, to ask for principles for prevention and solutions of crisis in the sovereign risk sector. And it's been done by the private sector with a negotiation with the issuers. It's good. I said already that I'm very happy that the IIF has taken very, very seriously this work of the private sector. If it appears in our eyes that the benchmark, voluntary benchmark principles or voluntary code of conducts do not suffice, then it's time to embark on possible new regulation. But the first chance, in my opinion, has to be given to the private sector. That being said, again, it's no time for complacency in any domain, in any respect, and I consider that for the existing regulation, a lot of improvements have to be worked out. You mentioned the formidable work of the Financial Stability Forum under the chairmanship of Mario Draghi. I think they have themselves a lot of workshops which are very, very actively functioning, and I hope that we will have the regular progress report that have been asked by the international community.
Jim, I would just say that working closely with both the private sector, our international partners, and importantly, the U.S. Congress, we're focused on taking a very careful look at what changes might be needed in our laws and regulations to prevent some of the excesses and abuses that we've seen from happening again. As I said, the turmoil is still working its way through the system. We don't want to reach premature conclusions. If we see a result that requires action, we'll do it. But for now, I think the work that we're doing in the President's Working Group and, as Jean-Claude said, in the Financial Stability Forum is laying the ground for action. We want to be balanced. We want to be thoughtful. We don't want to overreact. And I would say in the President's Working Group, we're talking about independent regulators working closely together. In the Financial Stability Forum, independent countries working closer together. I think we're going to find some good solutions. And in our case, too, we've been working quite closely with the Congress. The Senate Banking Committee Chairman Chris Dodd yesterday laid out his agenda for this year that includes taking a look at a number of these issues. Hank Paulson's meeting with him, if all goes well, at 4 o'clock this afternoon, Washington time, to discuss that agenda, how we can move it forward. And I might say, about a year ago, we were getting significant calls for new and quite severe regulation in the area of foreign direct investment into the United States. But working quite closely with the leadership, bipartisan leadership, including Senators Dodd and Shelby, including Congressman Frank and Backus, we were able to pass a law last summer, Foreign Investment National Security Act, strikes a very good balance between open investment and protecting our national security. Probably even better than the law that was passed back in 1988, because it's clear for people who want to invest in the United States. It's clear as to the relationship between the Congress and the executive branch. If we had tried to pass that law a year before, in the midst of the Dubai ports furor, we would not have produced the balanced, thoughtful result that we did. We might have overreacted. We're trying to avoid that in this circumstance while taking the action that we do think is needed, again, in the U.S. at this point, particularly around fiscal stimulus.
Right. Okay, Jamie, does the separation of risk origination and risk ownership call for a more prominent role then of rating agencies if we look for self-regulation? And then how do we handle the incentives to ensure that the proper risk information is available?
So let me just start with a bigger thing about risk management. The first rule of risk management is to have people running the risk that you know, that you trust, they're transparent, they have character. Anyone in a risk business is going to make mistakes, and character to me is not simple as if they even shave the truth, they shouldn't have that job. Second is really disciplined reporting, facts, information, which is rigorously reviewed by various parties, not just the traders, but the accountants, the risk managers, etc. And in fact, my experience has been a lot of very troubled companies. You can't even get the information when you ask, how much is my risk? I also would add, whether it's on balance sheet or off balance sheet, I personally don't care. We look at them all the same way. And I also look at the capital ratios that are applied. To give you an example of, it wouldn't have worked under Basel I or Basel II, one of these banks, the same one you're referring to, $80 billion of on-balance sheet and off-balance sheet risk that had $400 million of capital deployed to it that lost $20 billion. So, so I'd add another element, common sense. What can really go wrong? Rigorous review of new products. If you look at new products, I don't care whether it's equities, options, bonds, ginnies, derivatives, they almost always have problems down the road, settlement, clearance, so almost a heightened sense with regulators and how you're going to manage it. Operations cannot report to trading desks. Accounting cannot report to trading desks. If you look at a lot of problems in the past, they pretty much controlled it. I'm a fanatic about conservative accounting. I think that accounting can lead to a lot of these misincentives and things like that. And this should all be done by management. I mean, I personally don't think that it's risk management's job to avoid the risk. I think it's everyone's job to avoid the risk. And I also think if you do all of that right, you're still going to make mistakes. Our system wants people to make mistakes. We shouldn't look at it like any mistake is a terrible thing. And they're not terrible things. That is the life world we live in. What one of the great economists called it, creative deconstruction and reconstruction. And then when we do have new products, we try to work pretty close with regulators to make sure. I think it's wrong for firms to say no regulation. They should help come up with regulation that really makes sense. And you pointed out something about how rating. Most of the people I know who are buying those AAA securities, by the way, before the problem would have told you, I don't rely on rating agencies. We do our own work. We don't need them. Now, of course, once there's a problem, they turn around and they want to sue the rating agencies. And that's been common in these things in the past, too. So I think there were absolutely flaws. I think it's called some AAA, and that they can lose 20% of your principal. But, that was true for Enron. It was true for WorldCom. It was true for Penn Central. It was true for, a lot of different things. And so, but I do agree there's a real issue here about disclosure to investors where they understand, is there really embedded risk in that? By the way, if you don't want to take any risk, buy treasuries. And there is risk in the system, and we can't all have our cake and eat it too when it comes to some of these things.
Wes?
Well, I'm not a big fan of regulating things that the markets should otherwise take care of. I think one of the things that Jamie touched on is the whole issue with the rating agencies, and that's a complicated question because we do rely on them, and even though people do their own work, their imprimatur, their analysis of it is important. And ironically, when you look at the development of new products historically, generally when a rating agency rates some new product for the first time, they tend to do so too conservatively. You look back, I did the first commercial securitization that was done on the heels of the RTC back in 1991, I guess. And the total amount of credit support for that pile of commercial loans to be rated AAA was 55%. That same group of loans today, all things else being equal, would probably have had 10%. So, what happened is they started very conservatively. As they got better information, as things moved along, they became more and more and more aggressive about it. And that has been the case in virtually every asset class that I've been involved in, with the exception of the CDOs of CDO stuff. where really you could have these highly correlated risks that people didn't understand their correlation, and they're just too complex and went into it. And so I don't think that the regulation of the rating agencies is necessarily the answer, but I think it certainly bears a lot of scrutiny as to what the process is and really who ultimately holds the accountability for the process itself, because right now there is a big dissociation between the people that originate the products and the people that ultimately own the risk, and I think that that's an issue that's really worth talking about.
I need to point out, in the subprime business, and most of the mortgage business, it was not in a regulated business. As a matter of fact, some would argue it didn't end up in the regulated banks because the regulations were too tough, and it ended up in a non-regulated business. So a lot of that origination was not through regulated things, and there will be some regulation. And I think there is a legitimate issue about when investment banks or financial institutions get involved in securitization. If you don't originate it and you sell it, there should be some responsibility. Not the way the United States does it, where everyone can sue everybody and people who don't deserve it win. But there should be some responsibility so that people who buy something know that you have some skin in that game too.
Good. Okay, we're getting close to the end here, but I want to cover one or two more questions here. And Jean-Claude, market participants expect central banks to restore stability. I mean, obviously, when they all look to you and say, "Where are you?" Does this create moral hazard and provoke another crisis further down the road where they think there's this safety net?
Well, I don't think so, of course, provided we are sticking to what I suggested, namely, first, solidly anchor inflation expectations and devise the monetary policy stance with that view, which again is a prerequisite for financial stability, because otherwise you are destabilizing all expectations and increase volatility. And on the other hand, if you do the job as regards this smooth functioning of the money market, I don't see in what has been done across the Atlantic and across the Channel as regards the money market liquidity operation any such moral hazard. We did not bail out anybody. We did not privilege anybody. We only permitted those who had behaved properly not to be hampered very gravely by those who had behaved improperly at, again, the level of interest rate that we judged appropriate ourselves. And those big decisions that we took in the ECB and in the Euro system, together with the national central banks, on both, I would say, the providing of liquidity on a 3-month basis and on the liquidity that we provided through our main refinancing operations, including at the end of the year. These operations, the end of the year operation was very big, 350 billion euros. But we made additional money ourselves out of that. Not only we didn't bail out anybody, but we earned money. So we have to be very clear on that. Again, that being said, what we had observed on the money market was the reflection of tensions that are originating out of the money market. And we again have to contribute with all the private sector participants and with other authorities as central bankers for, again, as smooth as possible functioning of a system which, and I would very much echo what was said by the private sector participants, both of them, we are living in market economies. In market economies, there are risks. The risks are materializing from time to time. If the risks were not materializing, you would not be in a market economy, you would be in Soviet Union. And we could see what happened when risks are not materializing. It's the system itself which collapses. So we have to do all what we can to prevent the materialization of risks, knowing that from time to time they materialize, and then the resilience of the system is absolutely decisive. And I would say the resilience of the system, the resilience of the institutions. And we have to work much more on the resilience, including in the mathematical and economic theoretical underpinning of the system in which we are. Because what we observed, each time we have a big market correction, The correlation that were foreseen in advance do not operate as they should. The fat tails are appearing much more dramatic than what was envisaged, and all the Gaussian laws appear to evaporate. So I think that not only on a practical basis, as is being done by the various private sector and public sector entities which were mentioned, but also at the level of the theoretical research, a lot has to be done to better understand the kind of risks that we have in front of us, and to elaborate on the stress testing, which appear to be much more useful when times are very demanding than the value at risk that we all practice.
Okay, I think we are close, but I think what we should try to do is maybe take one or two questions from the audience. And if you can identify yourself.
Since we can't see it.
I think there's one right back.
Dennis Snower, president of the Kiel Institute. I have a question about whether there's some relation between the two functions that you outlined, one price stability and the other financial stability. In order to ensure price stability, the ECB created a lot of liquidity, and financial stability could not have been guaranteed otherwise. Should things turn up, how would the ECB prevent this liquidity from destabilizing or threatening the price stability goal that you have?
I can comment very, very briefly. For us, as you know, and as I said, there is one needle in our compass, which is price stability. And we have a two-pillar strategy whereby we look at the economic analysis and at the monetary analysis with components of the monetary aggregates and counterparts. So we look very, very carefully at all aspects, if I may, of the economy, whether real economy or financial economy, that we have in front of us. We, for instance, decided to increase rates in December 2005 on the basis of both analyses. At the time, there was a lot of good advices that we had received, including from the IMF or the OECD, not to increase rates in December 2005. We decided precisely on the basis of in particular, the information we had on our monetary analysis. And today, I would say that everybody is totally vindicating the decision we took at the time, and you would probably vindicate that decision yourself. The question shows that. Even if at the time, again, we were very bold, because practically all advices that we had received was not to do that. So I really trust that there is no contradiction between price stability and financial stability, and that, as I have said, it is a prerequisite, a necessary condition for delivering financial stability in a sustainable fashion. But again, for me, what is very important, including and more than ever in period of turbulences, is to continue as a central bank, which is responsible for stability, to continue to anchor very, very solidly these two elements that I mentioned. Inflationary expectation on the one hand, and of course the money market smooth functioning at the level of interest rate that we decide.
Okay, it is that time, and I promised the participants that on the panel that I would end promptly at 6:20. Jamie is very surprised. We know each other from New York. He can't believe I've become so Swiss and sticking to time like this now. But I thank, and I ask you to join me in thanking the participants on the panel for an excellent job. Thank you very much.